Stocks versus gold. The retirement truth they won't tell you. Here's something nobody tells you about retirement investing. Right now, someone your age is losing their retirement savings. Not because they were stupid, not because they didn't save, but because they believed one side of an argument that's been raging for decades. Stocks always win in the long run, or gold is the only real protection against what's coming. And here's what I've learned after studying thousands of retirement portfolios. Both sides are dangerously wrong, because the real question isn't stocks versus gold. The real question is, what actually survives the one moment that destroys retirement plans? That moment when everything drops and you still need to pay your bills. Today, we're exposing the truth about retirement protection that both Wall Street and gold dealers desperately don't want you to understand. Why this matters now. Before we dive in, you need to know why this conversation is more critical right now than ever before. This is episode 1 of our new series on retirement investing. In our last series, we covered where to live in retirement, the physical location. But what good is the perfect location if you run out of money in year 5? Here's the harsh reality most financial advisors won't say out loud. Most people don't lose their retirement money slowly over time. They lose it in one catastrophic period at exactly the wrong moment. 2008, people who were ready to retire lost 40% of their portfolios, and many never recovered. 2022, retirees watched both stocks and bonds collapse simultaneously. March 2020, the market dropped 34% in weeks. The pattern is clear. It's not about being smart. It's about not being vulnerable when disaster strikes. So let's talk about what actually protects you. Here's the first truth bomb, and it goes against everything you've been taught. Retirement investing is not about maximizing returns. Read that again. It's not about getting the highest number. It's not about beating the market. It's not about impressing your friends. Retirement investing is about survivability. Think about it like this. You don't need a race car when you're driving through a minefield. You need a vehicle that won't explode. Your portfolio needs to do 3 things. 1, grow enough to last 30+ years. 2, survive the inevitable crashes without forcing you to panic sell. 3, keep working even when you're withdrawing money. That's it. That's the game. And here's what's fascinating. When you design for survivability instead of maximum returns, you often end up with better long-term results anyway, because you're still in the game when everyone else has been forced out. Now, with that framework, let's examine what stocks actually do. Part 1, the truth about stocks. Let me say something controversial. Ignoring stocks completely is financial suicide for most retirees. There, I said it. Stocks are growth engines. Over long periods, they tend to rise. That's not opinion. That's historical data. If you refuse to own any stocks, you're choosing to lose purchasing power to inflation. Slowly, painfully, guaranteed. But here's what the stocks always win crowd conveniently leaves out. Stocks don't grow smoothly. They grow violently, chaotically, unpredictably. Look at the S&P 500. Over 30 years, up significantly. But during those 30 years, multiple 20% plus crashes, several 50% plus collapses, periods where it took 5 to 7 years just to break even. Now here's the killer question nobody asks. When do those crashes happen? You don't know. I don't know. Nobody knows. And when you're 35 years old with 30 years until retirement, a market crash is a buying opportunity. But when you're 63 and planning to retire in 2 years, that same crash is a catastrophe because you don't have time to recover. Here's the math they don't show you. If your portfolio drops 50%, you need a 100% gain just to break even. Let me repeat that. A 50% loss requires a 100% gain to recover. If you're young, you can wait for that. If you're approaching retirement, you're done. So here's the truth. Stocks aren't dangerous. Bad timing is. And you cannot control when the market decides to collapse. Part 2, the truth about gold. Now let's talk about gold. And I'm going to make some gold bugs very angry right now. Gold is not a growth asset. Gold does not pay dividends, generate cash flow, compound over time, create wealth out of thin air. If you put $100,000 in gold and bury it for 30 years, you'll have $100,000 worth of gold. Maybe it's worth more in dollars, maybe it's worth less. But the gold itself doesn't multiply. So why does gold exist? Gold is insurance. It has one job: preserve purchasing power when everything else is falling apart. Historically, gold shines when inflation is raging, currency is losing value, faith in the system is cracking, geopolitical chaos erupts, central banks are printing money like it's monopoly, During these moments, gold often holds value while paper assets crater. 2008 financial crisis, stocks collapsed 50%. Gold went up 25%. 1970s stagflation, stocks went nowhere for a decade. Gold went up 15 times. But here's the trap people fall into. They expect gold to do a job it was never designed to do. They expect gold to outperform stocks in good times. It won't. Gold to provide income. It doesn't. Gold to make them rich. And that's not the point. Gold's job isn't to make you wealthy. Gold's job is to prevent you from becoming poor. Big difference. And when people misunderstand this, they make catastrophic mistakes. The two deadly extremes. Here's where most people destroy themselves. They go to extremes. Camp number 1, all stocks, zero gold. These people say, gold is a useless rock. Stocks always win, just ride it out. And when they're 40, that works. But when they're 64 and the market drops 35% right before retirement, guess what happens? They're forced to delay retirement for years, sell stocks at the bottom to pay bills, watch their lifestyle permanently downgrade. Camp number 2, all gold, zero stocks. These people say the stock market is rigged. The dollar is collapsing. Gold is the only safe haven. And when there is a crisis, they feel vindicated. But over 20 to 30 years of retirement, their portfolio doesn't grow enough. They lose to inflation anyway. They run out of money in their 80s. Both extremes fail. All stock portfolios get destroyed by bad timing. All gold portfolios get destroyed by lack of growth. And here's the uncomfortable truth. Extreme positions feel safe because they're simple. Just do this one thing. But retirement doesn't work like that. Retirement is complex. Retirement spans decades. Retirement requires nuance. The people who survive retirement aren't the ones with the strongest opinions. They're the ones with the most balanced strategy. The reality they don't teach. Here's what changed everything for me. You don't retire all at once. Think about it. You don't wake up one day and suddenly need all your money. You retire over 20, 30, maybe 40 years, which means your portfolio needs to do multiple jobs. Year 1 to 5 of retirement, you need stability and liquidity. You can't afford a crash right now. Year 10 to 20 of retirement, you need growth to fight inflation. Your money still needs to work. Year 20 to 30 of retirement, you need preservation. You can't take big risks anymore. One asset can't do all of that. That's why you need stocks for long-term growth, gold for crisis protection and inflation, hedge bonds or stable assets for near-term stability, cash for immediate needs and flexibility. It's not sexy, it's not simple, but it's what actually survives real life. Because retirement isn't about winning. Retirement is about not being forced into bad decisions, and a balanced portfolio gives you options when others have none. So what's the answer? All right, let's answer the question directly. Stocks or gold, which one protects retirement money? The truth? Neither does it alone. And anyone telling you otherwise is either lying or selling something. The mistake isn't owning stocks. The mistake isn't owning gold. The mistake is thinking one asset can do every job. It's like asking, what's better for survival, food or water? You need both. And the exact ratio changes based on how close you are to retirement, your risk tolerance, economic conditions, your income sources. There's no one-size-fits-all answer, but there is a framework that works. Before we wrap, one critical warning. Allocation changes with age. What works at 35 will destroy you at 65. The closer you get to retirement, the less you can afford to be wrong. This is where people make the fatal mistake. They chase returns right when they should be protecting what they have. They see friends making money in crypto, meme stocks, or the latest trend, and they think, I need to catch up. Don't. Retirement investing is about positioning, not prediction. You're not trying to hit a home run. You're trying to make sure you can't strike out. This series isn't about hype. It's not about fear. It's about building a portfolio that survives reality, not just good markets. If you want episode 2, hit subscribe.